Swing Edge Pro, the intelligence feed for decisive traders.
All right, let's get straight to it. This is an intelligence briefing focused on Wizz Air. Our mission today is simple: identify a potential strategic edge in the market. So that brings us to the central question, right? Is what we're seeing with Wizz Air a high probability setup, or is it just a classic value trap waiting to spring on unsuspecting traders? Let's break down the intel. Okay, our target is Wizz Air. We're initiating a full target scan to get the tactical data we need for this deep dive. Right off the bat, our initial scan flags something important. Wizz is trading at a critical support zone. This is exactly why it's on our radar. You know, price action around these key levels, well, it often tells you everything you need to know about the next big move. Now, let's move into phase 2, edge detection. This is where we sift through the data to find our strategic advantage by pinpointing the specific technical setup at play. So the heart of this potential edge is a triple bottom pattern. Now, for anyone who needs a quick refresher, this is a classic bullish reversal pattern. What it means is that sellers have tried and failed 3 separate times to break below a key support level. That's a huge tell. It suggests the selling pressure is just, well, exhausted, and that momentum could be about to shift to the upside. And here you can see the pattern in black and white. We have hard data confirming 3 distinct tests of this support zone. Look at it. Bottom one at £10.55, a second bounce at $10.62, and a third at $10.15. All of these have been verified. They held. So this isn't some theoretical idea. It's a confirmed pattern right there on the chart. The technical picture looks compelling, for sure, but a pattern by itself isn't quite enough. The really critical question now becomes, who is holding this stock while this base is being built? Now, take a look at this ownership structure. We've got almost 50% held by institutions and another 25% held by insiders. You do the math. That's over 75% of the company in the hands of what we call smart money. When you see the big funds and the company's own management holding firm at these levels, man, that adds a whole other layer of confidence to that technical support. And it doesn't stop there. We're also seeing a string of positive catalysts adding to the momentum. Their passenger count is up 13%. They just delivered a strong third quarter with 10% revenue growth. They've announced new routes from Italy. And just on February 5th, the chart printed a golden cross. That's a really bullish signal. So the news flow is definitely lining up with the technicals. But, you know, a professional assessment is never one-sided. We have to look at the counterintelligence. We have to understand the risks. So it's time for a critical risk assessment. And this is crucial. Wizz does not meet all of our strict swing criteria. It actually fails on several key metrics. First, it's not as close to its 52-week low as we'd prefer. The year-over-year growth is, frankly, weak. Its cash-to-debt ratio could be a lot stronger. And that float size, it's much larger than our ideal target, which means it takes a ton of volume to really move the price. Let's just zero in on that growth metric for a second. Our target for a high momentum swing is somewhere between 20 to 30% year-over-year revenue growth. Wizz is currently delivering just 3.83%. I mean, that's a huge difference, and it's a primary reason for the bearish counterargument. It's also really important to note that there is zero short squeeze potential here. The cost to borrow shares is tiny, just 0.25%. So let's be clear, this is not a play on short interest. This is a pure value and technical setup based on that support level and the ownership. Don't go in expecting some kind of explosive short covering rally. Okay, moving on to execution. We've acknowledged the edge, we've looked at the risks, so now we can define the tactical zones for a potential operation. These are the critical price levels you absolutely have to watch. Your number one level to watch is £10.15. This is the absolute floor of that triple bottom pattern we've been talking about. If it holds above this level, that's tactically bullish. But a break below it, that would invalidate the entire setup right then and there. Your ultimate stop loss level is £9.69. Why? Because that's the 52-week low. If the price breaches this level, it's a catastrophic failure of the support structure and a clear, undeniable signal to exit. Think of it as your line in the sand for risk management. Now, on the upside, the consensus price target among market analysts is £13.57. This gives us a defined potential reward to weigh against our risk, right? It provides a really clear risk-to-reward ratio for the entire trade. And that brings us to our session close. It's time to consolidate all this intelligence and define the final strategic edge. So to wrap it all up, the strategic edge for Wizz Air is really built on 4 key pillars. First, you've got that confirmed bullish technical pattern at a major support zone. Second, there's a strong alignment with institutional and insider ownership, the smart money. Third, there's that recent flow of positive fundamental news. And finally, and maybe most importantly, you have a clearly defined risk versus reward scenario with specific price levels for execution. We've scanned the target, we've detected the edge, we've assessed the risk, and we have defined the tactical zones. All the intelligence is right there on the screen. The decision is yours. Session complete.
Swing Edge Pro, the intelligence feed for decisive traders.